Hello and welcome all. Finance Minister Nirmala Sitharaman presented her fourth Union Budget today. Union Budget 2022, under promise and over deliver. Does it seek to do that? There is a lot of push on capital expenditure for sure, and growth estimate figures are estimated at a conservative side. That's what Pankaj Pandey, Head of Research, ICICI Direct, tells us. Pankaj, welcome to the show.
Hi, good afternoon, Shaleen.
Pankaj, your initial thoughts on the budget?
So one, I think, the highlight of this government or even this budget has been the focus on or the sharper focus on the infrastructure as a segment. And historically, we used to spend somewhere about 1.5, 1.6 odd percent on as a percentage of GDP on the infrastructure. Now, this budget has taken it to 2.9%. So what is coming out very clearly is that there is a good amount of focus on the infra, and that is going to probably help the government in terms of more of inclusive growth, along with meeting other objectives of job creation, poverty elevation, and other factors. So I think that is the single most important thing which has come out in the budget. The other thing is that government seems very conservative in terms of numbers for next year. So, for example, next year, the nominal GDP growth rate has been taken at about 11 odd percent. Now, we all know that RBI is expecting an inflation of about 5%. So that means the real economic, real GDP growth rate being taken is about 6%. I think most of the economic estimates are much higher than what we have seen. So obviously numbers look conservative, and I think rightly so, because it is coming in the backdrop of a third wave, and we still don't know whether you will see fourth wave or any further waves. So which is why it is better to be sort of conservative, which is coming out clearly. And I think even the divestment numbers are also looking quite conservative. So while LIC might sail through this year, but I think even if this spillover of the previous year, what we see, gets achieved, I think FY23 divestment numbers still look conservative, which is why I think it is giving us an impression that the government is sort of under-promising and looking to sort of over-deliver both on the growth front and a number of other parameters. And I think this focus or sharper focus on economic growth, largely led by capital expenditure. And here you have two figures. So one is you are looking to do a lot more capex through public expenditure or public capex, which is where both central plus state governments participate. I think which is where we have seen nearly 35% jump in the overall allocation, and which is the highest which I just highlighted. And then what you are also doing is that you are looking to sort of do private sector capex by broadening the scope of sectors or segments which are eligible for participation in the PLI. So what you're looking is both capex being driven by public sector or public expenditure plus private sector. And eventually that is going to deliver more of inclusive growth and inclusive welfare for the society.
Pankaj, whatever, it's interesting. You said that all this capex will deliver inclusive growth. But that will take some time to play out, right? It will not all play out in the next 1 year itself. Right now, what the economy needs, in my limited understanding, is some immediate boost to recover from COVID. Any thoughts on that?
So I think, one is, capex is one thing which has been a very sharper focus, and I would want to sort of highlight that. So for example, road as a segment. Now, last year, the budgeted capex was somewhere about 5.5 lakh crores. Of that, road was about 1.08 lakh crores. Now, government has actually overachieved those numbers. Same is the case with railways. Then you have irrigation as a segment or water as a segment, Jal Jeevan Mission, where the allocation has been increased from 50,000 to 60,000. So you have key segments where which are sort of anchored or which are driving the overall capex. There, the achievement has been good. So it's not that you have sort of over promised and under delivered there. So from that perspective, I think market or equity markets typically would want to sort of look at measures which are far more long-lasting in nature, rather than sort of providing some incentive to some sector, which is a sort of a short-term in nature, so which provides probably a short-term boost, but does not structurally solve the problem of the overall economy. And I think what government is looking to do is solve the structural problems of the economy. I mean, which is where government is looking to sort of divest a number of more PSUs. Plus, they are looking to sort of create infrastructure, which again will drive manufacturing. And for that kind of a manufacturing, what you require is a Gati Shakti kind of a project where both central plus state governments are aligned. And we are looking at an integrated logistic ecosystem for this to deliver. Up till now, Indian economy has been largely service-driven economy. But manufacturing is something which has been a sort of a laggard, which is what the government is looking to do. And mind you, manufacturing has its own set of advantage for the overall job creation or for the overall uplifting of the society. I mean, imagine a cement plant being set up in a remote area. So not only you set up the plant, but you have to set up the entire ecosystem of. So that way it has multiplier effects on the.
That's okay, but what I'm saying is all those things take time to play out. How will all that help the economy in the very next year? That was my question.
So one is, see, economic growth this year has been quite good. So for example, this year nominal GDP growth rate is about 18% odd. Obviously, it is coming from a low base of 6 to 7% kind of a decline, like what we have seen. Now, when we look at sectors, most of the sectors have recovered to pre-pandemic levels. I think there are some sectors like, say, for example, hospitality, which are still sort of, or which are human contact facing sectors. I think those are sectors which have yet not recovered. But overall economic growth most of the sectors have recovered. So when sectors are already sort of doing well, so take an example of, say, for example, real estate as a sector. Now, real estate as a sector has already sort of been benefiting from the structural drivers. So obviously, you have both demand and supply sector side factors helping real estate as a sector. On the demand side, obviously, since the prices have been stable, so affordability has gone up, and then you have interest rates being at a lower level. On the supply side, since the number of players in most of the cities have come down, the share of organized players have gone up. And this has happened post-RERA and post-ILFS crisis, what we have seen. So obviously, no point in sort of giving a benefit to a sector like real estate by giving a higher sort of a tax deduction for interest payments and others, when the sector already sort of looking up well. So I think clearly the focus has to be there on more or structural sectors. So I think government in this budget has really not sort of looked at populist measures, which probably a number of some sections of the society were expecting. So I think that is where probably the disappointment is coming from. But I think from a market perspective, market so market that was happy. Yeah.
No, there was not no disappointment from my side, at least. It's just that I sometimes find that talking about next 25 years is always easier than talking about the next year itself. Anyway, before we move on to the impact on markets, I have one more question. If you look at the disinvestment numbers, the budget estimate was 1,75,000 crore, which has been revised down to 78,000 crore. Out of that, we have done 12,000 crore so far. So that leaves us with 66,000 crore to be filled in the next 2 months. If I were to assume that all that is coming from LIC, that's number one. And if that is, then are we looking at about 12 to 13,000 crore valuation for LIC? Am I right there?
No, actually, so so you're right in terms of assuming that the balance number is largely coming from LIC. So what we are expecting, probably when we sort of get more finer details or when we analyze more details, I think then I'll be able to tell you with more concrete confirmation. But as of now, our sense is that LIC could be valued somewhere between 12 to 13 lakh crores probably. And 5% of that will come to about 65,000 odd crores, which is what the budget, which is what the numbers are. I think the challenge is for next year because you will have a number of spillovers right from BPCL, right from IDBI Bank. So somewhere down the line, it looks like that the government has turned sort of ultra conservative for the next year, and which is why I think since they've taken such a big number this year and not really been able to achieve closer to those numbers. So they are starting on a smaller base, which is what I said, sort of under-promising and over-delivering. So that is what probably they are looking to do next year.
Sure. Let's move on to the budget impact on the markets. So after the budget speech ended, the markets remained where they were for some time, and then suddenly fell. Nifty fell below 17,400, and then it came back up to nearly 17,600 towards the end. What do you make of that?
So one, I think till the time, say probably till 12 o'clock, nothing much was clear. So budgets were sort of, or till that time, we didn't see movement in the market. Whatever the gap up or the positive opening was there because of the overseas bullishness what we had seen, especially US markets. Now, after that, I think divestment numbers is something probably created a disappointment for some period of time in the market. But I think when people realize that the government has been conservative not only in divestment but also in GDP growth rate, so which is where I think it came out very clear that the government is sort of a bit conservative. And since budget is quite capital focused, and which is why if you look at today, what we have seen is that all your core sectors like say banking, cement, steel, and the infra focused companies, especially the road PC companies, because see in capex in the 7.5 lakh crore capex, the biggest allocation has gone to roads. So, which is why you've seen some of the players sort of doing well. So, I think once I think initially people realized that it has got a clear focus in certain pockets and certain benefits for specific sectors, I think we have seen a bump up in those sectors.
Okay, and do you see this impact? The markets actually digesting more of the budget impact in next few days, and will try to go up or down?
So our sense is that since budget is quite sort of, or budget is market friendly, I would say. So from that perspective, as and when we sort of digest more of the finer details of the budget, I would expect budget to sort of head higher. I think the another perspective is that global debt volatility is sort of coming down as we have already seen both India VIX and global VIX coming down. So those events are behind us. Now the focus will be on the earnings side and also the finer details of the budget. Up till now, earnings have not really sort of disappointed. So that way, things are looking good. And I think whatever budget has been focusing, especially sectors like steel, cement, infra, or banks or capital goods, I think these are the pockets where we have not seen much of a price performance. And since some of these pockets, like say for example, banking and financial services contribute a good portion or have got a significant weightage in Nifty, our sense is that a positive rub off there will take Nifty to 18,000 plus kind of a levels in the coming days.
And in how many months or how many weeks are we talking about that?
So to put it conservatively, I would say probably 2 weeks.
Okay. And any views on Bank Nifty?
So Bank Nifty, I don't have a specific view, so I will not comment there.
Sure. Any other sectors that you see benefiting over the next 1 to 2 years, which people can buy and hold now?
So I think some of the sectors which are structurally looking positive, obviously one is IT because IT numbers have been good. IT spend globally, domestically is going to remain at elevated and that is going to benefit Indian IT companies. So structurally, IT looks good. Then I think capital goods is something what one can look at because what we are seeing in terms of capex, these are coming from new sectors, something which we haven't historically seen. So we would want to believe that with manufacturing as a leg coming up, this capex cycle will be a bit longish, unlike the previous capex cycle what we have seen, which was driven by traditional sectors. So capital goods and infra is another sector which looks good to us. And obviously the entire ecosystem in that. So whether it is selective cement players or selective steel players or selective metal players, selective banks and selective capital goods companies, both on the product side and on the EPC side. So these are the pockets which are looking good for in the market for the next 2-3 years.
This is very interesting, Pankaj. About a few months ago, everyone was talking about new age stocks, stocks such as Nykaa, Zomato, Paytm, and today here we are talking about the so-called boring sectors, cement, capital goods. Where has that shift suddenly come from? And also, does it mean that over the next 1 year, is it a good time to stay away from some so-called new age stocks?
Actually not. So when we look at new age stock, we look at it from the perspective how the business model is. So for example, of all the companies which have been recently listed, we have covered only one stock, which is Ease My Trip. Now, this is one company which has been making profits far more smaller in size compared to the competitor. So if your cost structure is right, I think sizing does not matter, and which is why we are of not the view that 5 years down the line, as the size becomes bigger, then the company will become profitable and will command value. So if the business model is right, and if even at a smaller scale, company is making profits, obviously when the size becomes bigger, they'll make even more bigger profits. Somewhere down the line, so we have covered or we have tracked or we have covered companies from that perspective. Now a lot of these companies are sort of not making profits, so which is where the challenge comes from. See, from a retail investor, if a business is not making profit, if the position is, or if they bought a stock and not really performing or not making profits, it is very difficult for them to sort of hold on to that stock. And imagine a business which is probably not expected to make profit for some years. It is very difficult to convince customers to sort of buy and hold that. So we are clearly looking at or differentiating where companies are making profits and how the opportunity is shaping. Now, valuation is a secondary thing, but yes, valuation side, some of the stocks are expensive, so which obviously is a sort of a does not make a very good risk reward case, and which is why most of the companies post listing we have avoided.
Sure. On valuations front, what about Nifty valuations? Are you still concerned about those valuations?
Actually not. So I think in Nifty, see, historically has traded at about 16, 17 times. Now it is trading at 20 to 23 times. Now, see, in Nifty, if you look at a lot of these new age companies or new business models or efficient business models are coming up. Take the example of an expected entry of, say, Apollo Hospitals. Now, a number of now Apollo Hospital is after Sun Pharma is the one of the stocks which has got the highest market cap. Now, this is one segment which has not been there historically, which is why the multiples are good. So obviously, you can't expect a company like this to command a multiple of 8, 9, which is what typically an oil company gets. Because yes, you can look at the predictability of cash flows for a longer period of time, unlike crude-oriented, commodity-oriented sectors. Now, since index is moving from less of commodity-oriented to these efficient business models, obviously the multiples will go up. And which is why I'm not worried with, and I don't compare with the historical 16 and a half kind of PE multiples. And I think that's a wrong way to sort of approach PE multiples.
Okay, and do you expect the multiples to hold there?
Actually, we expect multiples to expand.
Okay. Any numbers or timeframes for that?
So as and when, see, what is happening is that typically in an index, you will find stocks which are more capital efficient, valued better, and companies where the business model is less efficient. You'll see these companies getting moved out of the index.
Sure.
So our sense is that you will see a lot more new faces in the Nifty going forward, and a lot of older names might find a way out. So from that perspective, I think the multiples are expected to go up, because when we look at stocks, we would look at a bottom-up approach rather than saying that since Nifty is 25, so then some stock has to command lower multiples. So that is not the right approach. It's more of a bottom-up, because you are sort of taking companies from various sectors and segments.
Finally, you spoke about 18,000 in probably 2 weeks. Let's talk a little longer term, 1 or 2 years. Any targets for Nifty, and what are the factors that may drive up or drive down the markets?
So for next year or next 2 years, we expect Nifty earnings to grow at 25%. And for next 12 months, our Nifty target is 20,000. And parallel Sensex targets are about 66,000. And I think corporate earnings are the biggest driver, because what we are seeing is that a lot of sectors have started to sort of do well, with banking, the latest sector to sort of join back, because banking up till now was grappling with asset quality concerns, higher credit costs. Now, whatever profitability you are seeing is largely driven by lowering of the or lower credit costs. Now, once credit growth picks up, then I think you will see that also sort of helping banks. So corporate growth is the key driver. And I think on the risk side, obviously crude is a big risk, because inflation, whether it is US, Europe, or India, is a concern. India the concern is lesser compared to US. But yes, that leads to higher interest rates, and which is where I think creates volatility for the market, which is what we have seen in the last few days. So I think volatility could come back, and since crude is also driven by geopolitical tensions, so I think that will be a biggest risk factor for the market.
Interesting that you don't mention US Fed in this entire conversation so far. Is that not a risk?
So I think that event is already over, and and the other thing is, the US Fed is forced to hike rates largely because one of the factors of inflation. So inflation overall is the bigger problem for US Fed, including us and including other geographies.
Sure.
I mean, whether it is driven by supply side glitches or higher crude, I think is a thing. But crude obviously has been a bigger concern for us, so which is why.
Sure. One final question. You said that volatility has fallen in the last few days. Any advice for the F&O traders? How should they play in the market?
So I think I am not a right person to sort of comment on that. I think you'll have to catch hold of my derivatives team to talk on that.
Most likely I will.
Sure.
Pankaj, thank you so much for taking out time, and hopefully we'll catch up again soon for detailed discussion on budget and the direction for markets forward.
Definitely. Thank you so much.
Thank you.
Thank you, Shaleen.